We've got Arjya Chattoraj, who's a fund manager at Tokio Marine AMC. Thanks so much for joining in, Arjya. Just to put things into perspective, his firm actually manages something like $56 billion in global assets. Of that, about $4 billion are in emerging market assets. Arjya, let's talk about what you're making of the global development as a money manager who, of course, really has his hands in things here in India. How worried are you?
Okay, so this one doesn't really, derail the India growth recovery story as such. On the real economic, parameters, India is actually a beneficiary because India is such a big importer of crude and commodity. But India is also a big importer of capital, and it requires the capital to fund the next growth cycle. So the essential impact is whether over the short term that capital flows freeze up or not, and that's really the risk which one sees. But having said that, if you see, India will still stand out as one of the better relative growth stories in a slowing world. So as a yeah, India will get top mind share going ahead, because of the real economic fundamentals.
Arjya, as a what's your view on the index, the Indian index returns? How do you expect it to fare in 2015, as we are already higher by about 30% in calendar 2014? Should the return expectations be moderated by investors now?
So, start of the month we were 30% up, to today, and the month is not over yet, we are actually up just, 20% in dollar terms. It's been more than 9%, correction from the top this month itself, and that actually, increases the return expectations for the next year. But that is purely how the mathematics works out. If you see in terms of how much should be reasonable expectations now, I think consensus expects around 14-15% returns on a bottom-up basis based on current stock price levels and earnings estimates. And if you see, if you want to calibrate that with what we see in the real economy, we do certainly see rates coming down. We see real GDP growth pick up, and we do see a huge amount of margin expansion from the lower commodity price. So if we get 2% each of these three, then a 15 to 20% growth return next year is pretty much on the ballpark. I mean, there might be volatility, but that much we can surely expect next year as well.
Arjya, since you are an FI yourself, tell us your view on FI flows in the Indian markets going forward. We've already seen about $16 billion coming in from the FI side this year. How do you see flows run rate pan out for the next year? Can we match this year's healthy run rate?
So this year the flow show was mostly on the debt side. The equity inflows of 16 billion, which we have seen YTD, is actually on the lower side. If you see, since the last couple of years, the equity inflows have actually averaged between 18 to 20 billion dollars. So what we saw this year was almost 26 billion dollars of inflow on the debt side, and that is against the previous highs of 10 billion. So this year the flow show was on the debt next, and the equity was really not that large. Going ahead, if we are in an environment where growth is picking up and rates are coming down, those would essentially be flow supportive for India as a share of overall global savings. The thing to keep in mind, of course, is that a lot of these savings are concentrated among the surplus countries which are crude and commodity producing. So the pool of that would have shrunk as crude has halved this year and commodity prices have come down. But within a shrinking share, India's share of the pie will continue to be high. And I think the 16 billion this year has not been a large number at all.
Well, you're sounding pretty optimistic then. In that case, looking ahead, what should one's ideal portfolio look like? Is it too early, you think, to start looking at financials and be overweight on that particular space, given what we've seen bond yields do?
Okay, so we ideally would like to have a mix of cyclical and secular growth sectors. Secular because volatility is picking up, so you need some kind of secular parts as well. Within cyclical, the question really is between when do you move from the early cyclicals to the late cyclicals, and this year has been all about the early cyclicals, which is financials, auto and cement. The call is when do you move from early to the late, cyclicals, which is industrials. The thing is, of course, the market will price in before the real, investment cycle pickup happens. But right now, the real constraint in the economy is that the banking system, which is the state-owned banking system, doesn't have the financial balance sheet strength to support the next investment cycle. So when we see signs of recapitalization of state-owned banks, that would be an early sign that the time has come to look at deep, industrials like cyclicals like industrials, and we saw some of that happen with the RBI action of late, where they allowed this huge leeway to continue to refinance investment projects once they complete date of completion. So we are seeing the signs that the regulator and the government wants to make the banking system growth supportive, and we just need a few more signs before that shift happens.
Okay, last question then. What are your expectations from the budget next year? Some sections of the market, seem to getting a little impatient. They believe that the government has perhaps fallen short when it comes to all those promises it made on the reform front. Is that a bit harsh?
Okay, on the budget now, expectations would be high, and that's primarily because this is after several years of budget where the government of the day will go in without being constrained by issues like fiscal deficit or current deficit, etc. The fall in commodity and crude price has actually given huge amount of financial flexibility for the government to pursue its reform agenda. So the market would expect it to seize the moment, and in that sense, it's reasonable to have high expectations heading into the budget. What we really need is not some new ideas. It is essentially a roadmap to implement the existing ideas, which are essentially implementation of a roadmap of the goods and service tax, how you can have a credible way to transfer cash subsidies directly to the beneficiaries, and in terms of how do you make it easier for FDI to come into the country, which is really one of the binding constraints of the next growth cycle, which is need for capital. In terms of assessing how the government has done till now, there really are no easy fixes, and as long as the intent and the direction of the government has been right, markets tend to take a more patient view of things, which is what they have been doing till now.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.